Hey everyone, welcome back for another deep dive.
Always a pleasure.
And this time we're tackling investing.
Oh, yeah. One of my favorite subjects.
Specifically, we're going deep on a classic, Benjamin Graham's The Intelligent Investor.
It's a must-read.
Absolutely. We're using excerpts from the book and some commentary by Jason Zweig.
So we're going straight to the source.
Exactly. Our mission, should we choose to accept it, is to extract those core concepts that'll make everyone listening a more intelligent investor.
Sounds like a plan.
I gotta say, when I first read this thing, my mind was blown. It's basically like the bedrock of value investing.
Yeah, it's considered the Bible for a reason.
So first things first, what does it even mean to be this intelligent investor Graham talks about?
Right.
You have to be some kind of, human calculator.
Well, actually, Graham says it's not really about having a super high IQ.
Interesting.
It's much more about temperament.
Okay, now I'm intrigued. How does that work?
Think of it this way. Discipline, being able to stick to your plan even when things get rough.
Ah, the long game.
Exactly. Patience, seeing those investments through.
Not panicking.
Right. And always learning, always being curious about the markets and the businesses you're investing in.
So it's more about having a steady hand on the wheel than trying to outsmart everyone else.
You got it. You can't control what the market does.
True.
But you can control your own reactions.
And that's where one of Graham's most famous ideas comes in the margin of safety.
Oh, that's a big one. We'll definitely have to dig into that.
But first, something else that really jumped out at me.
Mm-hmm.
Graham makes this super clear distinction between investing and speculating.
And that's a line a lot of people blur.
Totally. He lays it out like this. A true investment is backed by thorough analysis.
Right.
Aiming for safety of principle.
Meaning you don't lose your money.
Exactly, and an adequate return.
Not getting rich quick.
Right. It's about building wealth steadily over time.
And anything else he says is basically just speculation or gambling?
He gives this great example about selling short as a way to illustrate the difference between a speculator and an investor.
So what does he say?
He says an investor buys something when they think it's worth more than its current price.
Makes sense.
But a speculator who sells short believes they can buy it back cheaper later on.
Right, because they think the price is going to go down.
Yeah, so basically they're betting on the price going down.
Not on the value of the underlying asset.
Exactly, and I think that's crucial for anyone to understand before they even start making any investment decisions.
Definitely got to know what game you're playing.
Now, speaking of games and understanding the rules, one of my favorite parts of the book is Graham's analogy of Mr. Market.
Oh, yeah, that's a classic.
So who is this mysterious Mr. Market, and why should we care?
Picture this right. You've got this guy, Mr. Market. He shows up at your door every single day.
Every day.
Yeah, and he's always trying to sell you stocks, but his prices, they're all over the place.
Sounds a bit unstable.
That's the point. He's super moody some days. He's euphoric.
Like everything's amazing.
Exactly, and his prices are sky high.
And then other days.
He's doom and gloom, convinced the world's ending, practically giving stocks away.
Oh man, sounds exhausting.
The key is you don't have to play his game.
Right, so he's offering you these prices, but you don't have to buy.
You don't have to sell either.
So how do we use Mr. Market to our advantage?
He's ruled by his emotions, right?
Totally.
And when he's being irrational, that's your chance to make smart moves.
I like it.
You buy from him when he's in a slump, offering great companies at bargain prices.
Like a clearance sale.
And you sell to him when he's overly optimistic.
When he's driving those prices through the roof.
Exactly. Don't get swept up in his mood swings. Use them to your advantage.
Okay, so Mr. Market's out there offering these potential bargains, but how do I know a good price when I see one?
Right.
Is that where the margin of safety comes in?
You nailed it. The margin of safety is like Graham's golden rule.
Okay, tell me more.
It's a buffer, a way to protect yourself from the unknown.
So it's basically admitting you can't predict everything.
Exactly.
And building in some wiggle room?
Just in case, because even with the best analysis,
Yeah.
you're going to make mistakes. The market's unpredictable.
Things happen.
Right. The margin of safety keeps you from losing everything when those inevitable surprises pop up.
Okay, can you give me an example?
So back in the 1940s, Graham was looking at this company, Northern Pipeline Co. The stock was trading at $65 a share.
65.
But through his research, he discovered the company held at least $80 per share in these super safe bonds.
Wait, so the stock was literally worth less than just one part of its assets?
That's a massive margin of safety.
Wow.
Even if the company's main business went belly up, investors were practically guaranteed to come out ahead.
That's a mind-blowing example.
It is, right?
And it really makes the concept click.
And get this, Graham actually used his findings to push the company to increase their dividend,
No way.
making even more profit for himself and other shareholders.
You didn't just analyze, he took action.
It's a great lesson for anyone listening. Intelligent investors don't just sit back and watch. They use their knowledge to make informed choices.
I love it. So we've got all these investors now armed with their knowledge and their margins of safety ready to jump in.
We're ready.
But Graham talks about two main approaches.
Okay.
Defensive, which sounds pretty hands-off,
Yeah.
and enterprising, which sounds a bit more active.
More hands-on.
So what's the difference, and who's each approach right for?
So the defensive investor is looking for simplicity.
Okay,
They're not spending hours poring over financial statements
got it.
or trying to perfectly time the market.
So they're more the set it and forget it type.
Exactly. Graham suggests a mix of good quality stocks and bonds.
Cool.
Maybe even using dollar cost averaging to keep things really simple.
Makes sense. And what about those who want to be more hands-on, the enterprising investors?
These folks are willing to put in the time and effort to find those hidden gems.
The diamonds in the rough?
Exactly.
Yeah.
Those undervalued companies that the market might be overlooking.
Okay.
They're looking to do better than just matching the market.
So how does someone figure out which path is right for them?
It's a journey of self-discovery.
Deep.
It all comes down to personality, how much time you're willing to invest, and your comfort level with risk.
It's about knowing yourself as much as knowing the market.
Couldn't have said it better myself.
All right, let's say our listener's feeling adventurous and wants to explore this enterprising investing world.
Okay, let's do it.
What kind of strategies does Graham lay out for someone who wants to be more active in the market?
He's got a few tricks up his sleeve, but they all come with their own quirks and potential pitfalls to watch out for.
Ooh, this is where things get juicy.
Oh, yeah. So one of his strategies is buying what he calls bargain issues. These are stocks that are selling for less than their net working capital.
Okay, so like imagine going to a store where everything's on sale for less than what it costs to make.
Yeah, think of it that way. Like you're getting the company's factories and equipment and all that stuff practically for free.
So you're basically getting the whole business for nothing.
Well, not quite free. You still need to make sure the business is actually not just a pile of junk.
Right, got to make sure it's not a lemon.
Exactly. But the crazy thing is, Graham found these kinds of opportunities pop up more often than you'd think.
So there are hidden treasures out there if you know where to look.
Yeah, and you got to do your homework.
No shortcuts.
Now, then there are what he calls special situations.
Okay, those sound interesting.
Yeah, it's like the investing equivalent of finding a rare vintage item at a flea market.
What makes a situation special in the investing world?
These are unique events, like when companies are merging or getting bought out or even liquidating.
Okay.
It's about spotting the difference between what the market thinks will happen
Right.
and how things actually play out.
So you're trying to anticipate the outcome.
And capitalize on those moments when the market gets it wrong.
Sounds risky.
It can be. That's why even for an enterprising investor, spreading your bets is key.
Don't put all your eggs in one basket.
Exactly, no matter how tempting it seems. Now, this might sound counterintuitive,
Okay.
but Graham also talks about picking growth stocks.
I thought he was all about value.
It's not a contradiction, more like two sides of the same coin. He knew growth stocks could be winners.
Okay.
But the key is not getting carried away and paying too much.
So finding that sweet spot where the growth potential is there,
Yeah.
but the price is still reasonable.
He uses this great example with Chrysler back in the 50s and 60s, the heyday of American car companies.
Oh, yeah.
In 1952, their price-to-earnings ratio was around 10.8, pretty reasonable by Graham's standards.
Okay.
But by 1968, after years of this booming growth, the PE ratio had shot up to like 11.8.
So the market was really betting big on Chrysler's future.
And that's the danger even for a fantastic company, when everyone gets too optimistic,
Right.
the price can get totally out of whack with reality.
So what happened to Chrysler? Did they live up to the hype?
Well, just a couple years later in 1970, they were reporting losses
Oh.
and the stock took a nosedive.
So even a company with great potential can go south.
It shows that even for a company with huge growth potential,
Yeah.
ignoring valuation can lead to trouble.
Don't just buy into the hype. Look at the numbers.
Exactly, whether you're focused on value stocks, growth stocks, or anything in between.
So even intelligent investors can make mistakes.
Oh, absolutely. We're all human.
What are some of those traps that even the smartest people can fall into?
One of the biggest is overpaying for those hot stocks. You know, the ones everyone's talking about.
Oh, yeah, FOMO, fear of missing out.
Exactly. It's easy to get swept up in the excitement, especially when the market's doing well.
Everyone else seems to be making money.
Right. But remember that Savold tire story from earlier?
The one that went up 250% on the first day.
Exactly what goes up fast can come down even faster.
True.
It's an emotional roller coaster that can just wreak havoc on your portfolio, not to mention your sanity.
No one wants a portfolio and a therapy bill.
Whoa.
What else should people watch out for?
Another trap is getting caught up in the IPO frenzy.
The allure of the next big thing.
Yeah, get in on the ground floor before it skyrockets. But the truth is, a lot of those IPOs...
Initial public offerings for those who are new to this.
Right. A lot of those don't actually live up to the hype.
So it's not just about getting in early.
It's about getting in on something worthwhile.
And often these IPOs are priced way too high.
Yeah, leaving those early investors holding the bag when the excitement dies down.
Buy on the rumors, sell on the news.
Exactly. And here's another one. Don't neglect to actually analyze the company.
Okay.
Just because a stock looks cheap
Right.
doesn't automatically make it a good buy.
You can't just go bargain hunting without knowing what you're looking for.
Exactly. You've got to understand the business, its industry, its financial health.
So be a detective, not just a shopper.
The intelligent investor digs deeper. They don't just look at the price tag, they look under the hood.
Love that analogy.
Mm-hmm.
So you've given us so much to think about.
It's a lot to digest.
But I have to wonder, given how much the market has changed since Graham's time,
Yeah, it's a different world.
what would he be interested in today? What would catch his eye?
That's a great question. You know, Graham was always adapting, always looking ahead.
He wasn't stuck in the past.
No way. He knew the market is always changing,
Right.
and a smart investor changes with it.
So if he were here today, what kind of company or industry do you think would pique his interest?
That's a tough one. But I think he'd be fascinated by companies that are using tech to disrupt traditional industries.
Like how Amazon changed the whole retail game, or how Tesla's shaking up the auto industry?
Exactly. He'd be looking for those disruptors.
But he'd also be looking at their financials.
Oh, absolutely. He'd want to see a track record of actually making money, not just burning through cash.
So it's not about chasing the hype. It's about finding the companies that can back it up with real results.
And I think he'd be extra careful with companies that are relying too much on debt to fuel their growth.
Addicted to what he called OPM, other people's money?
Precisely. Remember, Graham was writing after the Great Depression.
Right.
He knew how dangerous too much debt can be.
So even in today's world where money seems easy to borrow and interest rates are low,
Yeah.
a smart investor still needs to be aware of that risk.
Debt can boost your gains, but it can also magnify your losses.
Double-edged sword.
When things go south, it can turn a promising company into a disaster zone.
So it's all about finding that balanced growth potential, but with a solid financial foundation.
You got it. And I think Graham would also be drawn to companies that treat their shareholders well.
Companies that put their investors first.
Right. Companies with a history of paying dividends, buying back their own shares, and generally showing respect for those who own a piece of the business.
It's not just about finding a great company.
It's about finding one that values its owners.
It's really amazing how relevant Graham's ideas still are today.
I know, right?
Even though the market is a completely different beast than it was back then.
It's a testament to his ability to cut through the noise and get to the core principles.
Timeless wisdom.
Rational analysis, emotional discipline, focusing on the true value of a business.
It's about ignoring the hype and distractions and focusing on what truly matters.
That's the essence of being an intelligent investor. And remember, it's not about getting rich quick.
Right.
It's a long game.
It's a marathon, not a sprint.
Exactly. It takes time, patience, discipline.
But if you stick to Graham's principles,
and avoid those common traps,
yeah,
you can reach your financial goals and build real lasting wealth.
And don't forget, becoming an intelligent investor is a journey.
It's something you keep working on.
Always learning, always adapting, always questioning your assumptions.
Great advice. So for our listener who's eager to learn more, what should they do next? Where do they go from here?
Yeah, what's the next step?
Well, of course, I highly recommend reading The Intelligent Investor cover to cover.
It's a must-read for anyone serious about investing.
Absolutely. And there are tons of other great books and resources out there that build on Graham's foundation.
Maybe we'll dive into some of those in future episodes.
I'd love that.
Now, before we wrap up, I want to leave our listener with something to think about. If Benjamin Graham were here today, what one company or industry would he be most interested in, and why? Think about those criteria we've talked about: intrinsic value, strong financials, how they treat shareholders, and the potential to disrupt the status quo.
That's a fantastic challenge. It's a great way to put all this knowledge into practice.
So for our listeners out there, happy investing, and we'll see you next time for another deep dive. It's not just about finding a company Graham would love. It's about using his principles to make smart choices yourself.
Yeah, exactly. It's like building your own framework for evaluating businesses, becoming your own investing detective.
One thing that always gets me about Graham is that he cuts through all the noise and sees what really matters.
He wasn't chasing fads or getting caught up in trends.
He was all about the fundamentals, earnings, assets, dividends, the building blocks,
The stuff that really makes a business tick.
Exactly. He had that famous quote, in the short run, the market is a voting machine, but in the long run, it is a weighing machine.
That's a powerful image.
It is. And I think so many investors today get lost in those day-to-day swings.
They forget about the long term.
They forget about that weighing process.
Trying to build a house without a foundation.
And Graham's work really gives you that foundation, that solid ground to build your investing strategy on.
For sure.
We talked earlier about Mr. Market and his crazy mood swings.
Oh, yeah.
How should an intelligent investor handle those ups and downs?
Graham was super clear about that. He said those price fluctuations are only meaningful for one reason.
Okay, why?
They give you a chance to buy low when everyone else is panicking and sell high when everyone else is getting greedy.
So it's about recognizing when Mr. Market's emotions are getting the best of him.
Exactly.
And using that to your advantage.
You got it. The intelligent investor doesn't freak out when the market takes a dip. They see it as a buying opportunity.
Makes sense. And when the market's going crazy,
Yeah.
they don't get caught up in that euphoria.
Right. They take a breath, maybe take some profits off the table.
It all comes back to discipline, sticking to your plan, even when things get wild.
Easier said than done, of course.
Definitely. But it sounds like that's the real secret sauce for success over the long haul.
It really is consistency and discipline.
This has been a fantastic deep dive into the intelligent investor.
I agree.
We've only scratched the surface, but hopefully this has given everyone listening a good taste of what makes this book so powerful.
It's a book you can come back to again and again.
Always find something new.
That's the beauty of Graham's work.
It really is. It's a lifelong journey of learning and discovery. So to everyone listening out there, keep learning, keep growing.
And keep investing intelligently.
We'll see you next time for another deep dive.